About a month ago, I came out with a video titled, Amazon Stock Will Double From Here. The video was pretty basic. I went over my investment thesis on Amazon and why I personally believe the stock is likely to double in price over the next 3 years. Now, there's no guarantees. This is a bet I'm making, an educated guess based on a lot of information. And I'm one that I actually put my money where my mouth is. So I've invested around $50,000 of money into Amazon over the past year. And it's down a little bit right now. It's down $7,600. I still have a holding size though of $42,000. And I continue to buy more and more of this company, especially when it trades down in price. In this video, I want to revisit not my specific analysis on Amazon, but the overall theme of a good company and why I consider Amazon to be a very, very good company. I studied a lot of the differences between good companies and bad companies over the past 6 months. And a lot of the work that I've referenced and learned from is that of Terry Smith. If you don't know him, he's a British investor. He's basically the Warren Buffett of Britain. And his whole investment shtick, the whole thing that he does and that he's done for the past 12 years, the thing that's earned him a lot of outperformance with Fundsmith is investing in good companies and not investing in bad companies. He breaks down his investment idea, his investment thesis into 3 steps. Buy good companies, don't overpay, and do nothing. That's his whole investment thesis. Now, there is a little bit more to that strategy than meets the eye, a little bit more than those 3 basic steps, because identifying what a good company is up to interpretation. The way that Terry Smith does it, and the way that he's outlined in his investment presentations, is based off of 5 main factors. The first one, and the most important one, the top factor that he looks at with every company, and the one that he says is at top of mind whenever making an investment, is the ROCE. You can see it outlined right here on their look-through ratios. ROCE stands for returns on capital employed. Terry Smith's portfolio is full of companies that earn above average return on capital employed. And even though that's not the only factor he looks at, it's the most important one that he looks at. Return on capital employed is basically how effectively a company can use money to make more money. That's all it measures. If the company's given capital, how much money can they make with that capital? The higher the return on capital employed, the more effective the company is at reinvesting that capital. And Terry Smith looks at this as a key identifier of a good company. Now, of course, I've started to look at this ratio as well and learn about it and factor it into my investment thesis. In fact, I introduced this ratio as one on Qualtrim, which you can look at and see the return on capital employed historically for any company. Estee Lauder, one of Terry Smith's holdings, has historically very high returns on capital employed. Microsoft, which is Terry Smith's biggest company, his biggest holding by far, also has very high historical returns on capital employed. And of course, that is a common theme amongst all of his holdings. He invests in good companies, and good companies have high returns on capital employed. So even though return on capital employed is obviously an important metric, and one that Terry Smith gives a lot of priority, a lot of thought when making his stock picking decisions, it's still a little bit abstract. I have to admit that when I try to figure out what it is or really what it means, it's a little bit more difficult than most other metrics. What does it mean in terms of percentages? What type of difference does ROCE make on the long-term performance of the company? That is difficult to understand. Well, luckily, he gave us this example. This is an actual example of 2 hypothetical companies, and one of them has higher ROCE than the other, the return on capital employed. And Terry Smith goes through and explains the actual financial impact this metric has on the long-term performance of the company. So I want to go ahead and just play a little segment of this because I think this is the most clear illustration of how important this metric is. He starts off with Company A and Company B.
Company A makes a 20% return on capital. Company B makes a 10% return on capital. Just to save us a lot of sort of strenuous arithmetic, neither of them pays a dividend. They both invest all of their profits back into the business at the same rate of return. Okay, who wants to own A? This is a show of hands thing. B, anybody? Anyone want B? No, good. You've all been listening. Oh, there's a man with B over there. We've got a man with B. Well done.
With the data points given so far, there's literally mathematically no reason you would believe that Company B would perform better. Because what we know so far is that Company A has double the returns on capital employed than Company B. And we know nothing else to distinguish them.
Sir, yeah, not even my regular straight man. Good. Now, I haven't, of course, as ever with any question I ever pose, it's always completely unfair because I haven't given you enough information to answer the question. You need to know what value you buy it and sell it at, don't you? So here's what happens with these two shares.
All right, so we get to this part, and this is where it actually gets interesting, because a lot of investors will cite this phrase. I don't know where it originated from, but it's not what you buy, it's what you pay. That's what you've heard a lot from different value investors. Keep that in mind when you're looking at this example.
Unreasonably, A, the 20% returner is priced, the shares are priced at 4 times its book value. Whereas B, the 10% returner, is only trading at 2 times book value when you buy them. Okay, who wants A? Anyone want to join this gentleman on B? Can't see any. Oh, a couple of B's over there. Well done, well done. Yeah, good. Okay, still haven't got enough information. How about when you come to sell them? Okay, when you come to sell them, it's all gone horribly wrong. If you bought A on 4 times book, the rating's halved to 2 times book. And that's a bit of bad luck, isn't it, really? It happens, I suppose. B, you've done very well. It's gone from 2 times book to 4 times book. The rating has doubled in the time that you sell it. Okay, who wants A now?
So just to clarify, looking at the example here, the price that you're paying for company A is literally double as expensive as the price you're paying for company B. So you're buying it at double the price to book value. And then over the lifespan of the 40 years, company A's multiple gets cut in half. So it has multiple compression while company B has its multiple expand double. So company A is twice as expensive to start with, has the multiple cut in half. Company B is half the price and has the multiple double over its lifetime. There's your answer. We have the compound annual growth rate of company A being 18% and company B being 12%, which is a substantial difference over a long period of time. And that's even with overpaying for company A. That's even with the valuation compressing by 50%. And the counterexample, you have the best case scenario. You have a company that goes up twice in terms of its multiple. That's what every investor wants. But if you leave out this one piece of math, this one metric, return on capital employed, you're leaving out something that has a massive impact on the overall returns. Companies that earn higher returns on capital employed mathematically have much better returns over time. And it makes up for even overpaying for them initially in some cases, like you see in the example here.
If you are going to be a long-term investor, and I hope you all realize by now we are on your behalf, whether or not you are investing in a good company that makes high returns and can reinvest in its business at something like those high returns is the single biggest determinant of the outcome.
All right, so now that we have a solid mathematical example of how important this metric is, it seems like less of a theoretical, difficult to understand thing. What we know is that companies that earn above returns on capital employed have better returns over time. And if they can continue to do that on a yearly basis, their returns will be insane. They'll be crazy in some cases. That's what's happened with many of the great companies of the past. Now, I'll also give credit to Terry Smith. He seems somewhat like a genius of thinking about this and investing this way. His performance has been really good. It's been market beating since the inception of his fund. And he's also performed well during the sell-off. He hasn't crashed like Cathie Wood or Tiger Global or many other funds during this difficult market. But I also have to give someone else credit, because Terry Smith, self-admittedly, doesn't take credit for realizing that returns on capital employed are very important. He credits it to Warren Buffett. Now, I thought that was interesting because Terry Smith is saying Warren Buffett talks about returns on capital employed all the time, and for some reason, I don't remember him ever saying that. I don't really recall him emphasizing this point that much. But when I actually looked into it, did a little research, Warren Buffett did indeed talk about returns on capital employed quite frequently. In fact, he outlines it as one of the biggest things that he looks at in identifying a good business. This clip in particular is taken from his 2007 shareholder meeting.
What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time and where we think the management will treat us right.
You see what he did there? He just gave the definition of a great business. A business that earns high returns on capital employed for a very long time. And he throws in, it also has a good management team. So he might have a little bit of a nuance there, but he has ROCE as the only metric, the only objective, observable metric that he mentions in the definition of a good business. Now, this actually gets more interesting because if we reverse just a little bit on this clip, the original question wasn't about what is a good business. The original question was about a margin of safety. You see, a lot of investors, a lot of value investors, they look for cheap prices. They look for underpriced securities. And the more underpriced they can get, the more they call that a margin of safety. They say that I'm not paying even fair value for a company. I'm not going to pay overpriced for a company. I'm going to look for the deep value ones and get that big fat margin of safety so that I don't lose money. That's the attitude most investors have. And this investor asks a question to Warren Buffett: what type of margin of safety do you demand on the holdings that you're buying, on the companies that you look for? And the answer, again, from Warren Buffett is a little bit surprising. He doesn't seem to look for that much of a margin of safety at all.
We favor the businesses where we really think we know the answer. And therefore, if a business gets to the point where we think the industry in which it operates, the competitive position, or anything is so chancy that we can't really come up with a figure, we don't really try to compensate for that sort of thing by having some extra large margin of safety. We really try to go on to something that we understand better.
Notice how the first thing that he goes to is not a number, not a calculation of the margin of safety. Warren Buffett doesn't say, yes, the margin of safety that we look for is a 20% underneath fair value, or a 40% underneath fair value. His margin of safety that he outlines, the first thing that he mentions is we think we're right. That's the margin of safety. He thinks that he's correct. And importantly, he avoids companies that he considers to be unpredictable. He thinks that there's a decent chance that he might be wrong. He just won't put money in it to begin with. So if he thinks he's right, then he'll invest. If he thinks there's a chance he'll be wrong, then he doesn't invest. And therein lies the margin of safety. It is not an actual calculation.
So if we buy something like See's Candy as a business or Coca-Cola as a stock, we don't think we need a huge margin of safety because we don't think we're going to be wrong about our assumptions in any material way. What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time, and where we think the management will treat us right. We don't have to mark those down a lot when we find those factors.
Buffett, in a way, is doing the same thing that Terry Smith does. He's encouraging investors to, instead of focus on margin of safety and getting a so-called discount on a cheap stock, he's encouraging them to focus on buying into good businesses at reasonable prices that earn high returns on capital employed. And this is a consistent message that he's shared for the past 20 years. And when he goes on in this clip, he actually says that when he finds a business he really likes, that he thinks it's a predictable business, he doesn't really require a margin of safety at all. In fact, sometimes he'd pay right up to fair value for it.
We'd love to find them when they're selling at 40 cents on the dollar, but we will buy those at much closer to $1 on the dollar. We don't like to pay $1 on the dollar, but we'll pay something close. That's not the way we do it. If we can buy good businesses at a reasonable valuation, we're going to keep doing it.
Now you might have an idea of where Terry Smith got his whole investing philosophy. As Terry mentions, his investing philosophy is based heavily on Warren Buffett. Here's another clip from 1997, another Berkshire Hathaway shareholder meeting, and this is on the same subject. Warren Buffett's asked about his biggest investing mistakes, and the actual mistakes he makes are somewhat revealing.
There's a lot of mistakes that I've repeated. I can tell you that. The biggest one, probably the biggest category over time, is being reluctant to pay up a little for a business I knew was really outstanding, or to continue to buy it at higher prices when I knew it was outstanding. So the costs of that have been in many, many billions, and I'll probably keep making that mistake.
In 1997, the biggest mistake Warren Buffett says he makes is not paying up for a really good business, not being willing to buy it at higher and higher prices. So here we have Terry Smith's entire investing philosophy centered around buying great companies, not overpaying, and doing nothing. Then we have Warren Buffett telling us repeatedly that the best margin of safety is buying a good company. And if you find the right company, you really don't need to demand much of a margin of safety in terms of price at all. He also says that the biggest mistakes he's made is not paying enough and adding to positions of really great companies, because great companies are few and far between. Now, we know from Terry Smith and Warren Buffett that return on capital employed is one of the signature things that describes a great company. And I wanted to dive in and find out what other things Warren Buffett looks at. If he was to define the ideal company, one that would be the best company in the world, the best compounder in the world, what would that company look like? And I found his definition of it, this hypothetical company, in a 2003 shareholder meeting. Now, before we get to this clip, just a quick shout out. We have the sponsor, which is FTX US. If you haven't already, download the app, sign up for the website. They do have a stock brokerage account. It works flawlessly. We've had lots of people try it. When you sign up, use the refer code Carlson, my last name. That'll make it so that when you do your first $100 trade, you'll have $10 credited to your account. And when you sign up, let me know what you think about it, because so far the feedback has been pretty positive.
The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine.
Now, right there, he breaks down two things that make up the ideal business and what he calls a compounding machine. It earns high returns on capital, and it can employ a lot of capital. It can keep iteratively putting more and more capital back into the business. And that's a little bit of a nuance. Not only does the company need to earn returns on capital, but it also needs to employ a lot of capital. And Warren Buffett goes on to elaborate on this little nuance here, that how much capital a company can redeploy back into its business is an instrumental part of it being a compounder.
If you could put $100 million into a business that earns 20% on that capital, say 20 million, ideally it would be able to earn 20% on 120 million the following year and 144 million the following year and so on. That you could keep redeploying capital at these same returns over time. But there are very, very, very few businesses like that. The really, unfortunately, the good businesses, you know, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible.
That's the problem with a lot of these great companies. They earn high returns on capital employed. You'll see that metric at 20, 30% for these type of companies, but they just don't have a way to deploy as much capital as they earn. That's another way of saying that they just don't have as many reinvestment opportunities. When Coca-Cola invests in its infrastructure, it builds out its network, and it does advertisements, it's basically done, and it's producing way more cash flow than it knows what to do with. And that's where you get into the problem of them not having reinvestment opportunities.
So we would love the business that could keep deploying, in fact, even well beyond the earnings. I mean, we'd love to have a business that could earn 20% on 100 million now, and if we put $1 billion more in it, it would earn 20% more on that $1 billion. But like I say, those businesses are so rare. There are a lot of promises of those businesses, but we've practically never seen one. There have been a few.
They know that most of the companies they invest in eventually max out with their reinvestment opportunities. What do those companies do when they have no other place to reinvest? They pay a dividend. That dividend goes to Buffett's pocket, and then Buffett can redeploy it into other businesses. Once they max out their reinvestment opportunity, they pay a dividend, and that's the compounding machine. Buffett redeploys all the extra capital from these great businesses into different businesses. But Buffett would still prefer a company that could effectively redeploy all of its capital back into its business. That would be the preference. That's the unicorn. That's the company that's nearly impossible to find. Now, if we look at this ideal business that Buffett describes, this unicorn-like business that both has high returns on capital employed, and importantly, it can reinvest all its incremental cash flow back into the company, leveraging its business to continually earn high returns on capital employed, well, that would be a very special business. That would be what Buffett calls a compounding machine. And I've looked across the market trying to find any business that meets that criteria. I don't know if this one is it. I'm not saying it is it, but I think it's the closest thing we have. I think Amazon fits that description better than any other company. If we look at what Amazon's basically done since the beginning, is it's never distributed cash back to the shareholders. It's always continually reinvested back into its business, longer than any other company, I think, in history. Most companies reinvest into their business, and then they start paying dividends, they start realizing cash flows, and then they run a lean, efficient company with their initial investment. And they don't try to continually reinvest because most of that incremental cash flow can't be invested with high returns. But Amazon has defied the odds for over 20 years. This company has a culture of day one. They have a culture of invention. They have unconstrained the bounds of moving from one company, one industry to another. They jumped from a bookseller to an everything store, to IT in the cloud, to physical retail, to machine learning, to home robotics, to audio, music subscriptions, to entertainment and media. This company doesn't behave like most companies. They take all of their cash flow and they throw it back into their company. Now, looking at the actual returns on capital employed, it swung into the positive in 2003 with very high returns on capital employed. This was after the dot-com bubble burst and Amazon had to prove that they could make money, right? The stock was going down 90%, and they had to show investors, look, we can make money. We can show that we're making money. So they had 30% returns on capital employed, 27%, so on and so forth. This number declined substantially all the way to 2015. Now, over the past 5 or 6 years, Amazon's return on capital employed has actually been climbing a little bit, going from that 1% to 7%, up to around 13, 11, and 12%. And even despite the fact that it's climbing, their operating profits are growing, the company's becoming much bigger, the moat's widening, Amazon continues to do exactly what they've been doing all along. They're reinvesting back into their company, and they're doing it more aggressively right now than ever. In 2021, they had minus $15 billion of free cash flow because every penny that Amazon made in cash flows was thrown right back into their infrastructure. When you look at the scale of investment, nothing really comes close to Amazon. You can slice and dice the different metrics and put them into different categories, but their R&D budget was $56 billion. Their general and administrative is $8.8 billion. Their sales and marketing is $32 billion, and they record $61 billion of CapEx last year. And this number is likely to be about the same in 2022. In fact, it may actually go up a little bit. Amazon's scale that they're reinvesting back into their business is unparalleled. And the big question for investors is what type of returns are we going to get on this invested capital? That's the wager that we're making with this company. My assumption is over the next 5 years, we will see this number go up because I believe the investments Amazon is making will be effective. I think they will have high returns. Now, saying that these investments will be effective and they'll earn a good return is one thing, but knowing whether that's going to happen is another thing. The future is uncertain. And like Warren Buffett says, the best that we can do is look for companies that we really think we're right on. Companies where we really think the future is going to work out like we see it. Now, with Amazon in particular, when I look at this investment, the way that I look at predictability is based off historical data. That's the only thing we can look at is present data and historical data, and we try to gain insights for the future. It's the best information we have. If I look at the different incomes of Amazon, their actual income and revenue per segment, this is what it looks like. Their physical stores is probably the most unpredictable part of the company. It went up in 2018. They've been doing acquisitions. I think this includes Whole Foods, and it's around $17 billion and pretty flat. This is not a predictable part or meaningful part of Amazon's growth. This is more of a sideline thing. It could become meaningful over time, but right now, this is not central to my thesis. When I look at meaningful and predictable parts of Amazon's growth, I go to different segments like the advertising. This chart is from The Science of Hitting on Twitter. You can follow his account. This visual shows quarter over quarter Amazon's 12 trailing months of advertising revenue. This has been incredibly consistent in its growth, and this has actually grown in revenue and is growing faster than Google and YouTube. So not only has this been consistent, it's also been incredibly fast. And unlike other parts of Amazon's business, this part's highly profitable, has very high margins. Amazon, over the last trailing 12 months, did $33.9 billion in advertising. Now, this could go down, theoretically. If we went into a big recession and advertisers pulled their budget, that could affect the entire advertising market. But in terms of actual predictability, long-term secular trends, I only see this growing. Online retail in general has strong secular growth trends, and Amazon's advertising portion on their retail is getting better and better, more effective, and it will grow right along with the online retail. The next thing that we can look at in terms of predictable and reliable growth for Amazon is, of course, the central of the company now, which is AWS. This is the most important component of Amazon, their web services. Now, this graph shows the run rate, which is based off of multiplying the last quarter times 4. And last quarter, the run rate for AWS was nearly $80 billion. That's a very high amount for a very predictable and high margin business. This visual shows the 2-year stacked growth of AWS. Now, it's generally speaking gone down over time because the growth rates initially were at 112% over a 2-year stacked basis. That's very fast. They're not going to keep that growth rate forever. It went down to 71%. And then over the past 6 or 7 quarters, it's actually been climbing. Now the 2-year stacked growth rate of AWS is around 80%. It might slow down a little bit, but the growth will continue for AWS for the foreseeable future. This is highly predictable income. This chart I've shown before, but it's AWS's commitments from customers for the future. The red bar is their actual quarterly revenue. So that's how much money AWS is actually realizing as revenue. That's the reported number. The blue bar is customer commitments that are greater than 12 months. So the amount of actual commitments in the future continues to grow. We know that this company right now has over $100 billion of future commitments just for AWS. Even the less predictable parts of Amazon, like the online stores, and this growth should continue in the future because every single study, every single analysis on the subject shows that online retail is not yet saturated. The third-party seller business is actually more important than their first party because the margins are much higher. The revenue recognized here is only from their fees, not from the total amount of items sold. So it underrepresents the amount of money moving over Amazon's e-commerce website. There's simply much more money moving from third-party sellers. And this is even above $100 billion now, going up steadily over the past 3 years. I consider the growth of this to continually be pretty predictable. It'll have bouts and time periods of fluctuation, but the long-term trends show secular growth. And then finally, we have subscription income, your Amazon Prime membership, Amazon Music, Audible, we have Amazon Prime Video. Anything that they make money through subscriptions is added into a pile, put into this bucket, and this has grown to $31.768 billion last year. This is a meaningful and fast-growing and highly predictable part of Amazon's business. So when I actually break down Amazon's revenue streams into different components in different businesses, I don't see this convoluted, unpredictable big tech company. What I see is a company that's effectively diversified its income into a lot of very predictable, high growth industries where they can effectively reinvest massive amounts of capital. And that's the wager that I'm making. That's a calculated bet that I'm making. I think this company does have the potential, no guarantee, but I think it does have the potential to be that unicorn still. The company that can take 70, 80, $90 billion of incremental capital, pour it back into its various efforts, and still earn a high return. They can do that because of the unique privileged position they're in with all the various assets that they own, their market position, their moat, their membership, their brand value, and their unique, very unique position with AWS. There's really not many companies situated like Amazon. So again, there's no way of knowing how this is going to turn out. I could eventually lose money with Amazon if the investments they're making turn out to be really poor and they don't earn good returns. But my thoughts are, out of the different options I look for, again, I don't see any other company investing at anywhere near the rate Amazon does with the potential to earn as high returns as they do. I just don't find it in the market. So that's my thoughts overall. And again, this video and the ideal company could be applied to many different companies. If you think it's a different one than Amazon, if you think there's a different company that fits that definition, let me know what it is and I'll do analysis on it. I'll look at it. But that's my thoughts so far. So I hope you enjoyed this little look into the ideal company, into my thoughts on Amazon, into predictability of businesses. I'll have more videos out like this in the future, so make sure to subscribe, and I'll see you next time.